Good evening, everybody. I'm Peter Atkinson, the CEO of Macfarlane Group. I'm going to try and see if I can make cardboard boxes as exciting as gold. The Macfarlane Group is a very well-established business. We're quoted on the main London Stock Exchange. Sales this year will be around about £160 million, and we're operating primarily in the UK. Our major focus is as a supplier of protective packaging materials, and I'll define what protective packaging is for those of you who are unused to that concept. And what we're doing is providing our customers with protective packaging to ensure their products get to either point of use or point of sale in an effective, controlled, protected way, so they don't have damages, they don't have returns, they don't have recalls, they don't have insurance claims. The customer sectors that we operate in the UK, the fastest growing sector for us is internet retail. As more of us buy stuff over the web, then that requires more and more protective packaging. So that's our fastest growing segment. We're also very active in supplying packaging to major logistics companies, the electronics business, the aerospace sector, and the automotive sector. We're the only distributor in the UK with national capability, and we've got around about a 25% share of the UK market. So we are the major player in the UK. In a very fragmented market, which I'll explain later. The role of a distributor is we don't make anything. Our job is to basically guide and advise our customers independently. We don't have to have factories to fill. We have suppliers who we can choose, and we can guide customers on the best choice to protect their products in a cost-effective manner. Our shareholding base is pretty extensive. We've got around about 55%, which is major long-standing city institutions, got a strong private investor following, and then the Macfarlane family and the directors have around about 10% of the group currently. Let me describe to you the structure of the group. The group is organised in three businesses. The major business, 80% of our revenue, is driven by our packaging distribution business, and I'll focus most of my comments there around that business. We then have a specialist design and manufacture business. We do a little bit of assembly and design for very specialist packaging applications. And then alongside this, we have a labels business, which doesn't overlap with any of the other businesses. It's a standalone business providing labels to UK FMCG customers. If we just take a quick look at protective packaging, very simplistic diagram. If you think about anything, and we've used a bottle of wine as a very, very simple example, clearly the bottle of wine is packaging. Okay, that protects the product, and it sort of identifies the product, and it gives you guidance as to what's in that particular piece of packaging. That's not our business. We're not involved in the packaging that you see on supermarket shelves. What we're into is the packaging that gets the product to the supermarket, to the point of sale, to the point of use. So in the very simplest of terms, we're supplying cardboard boxes, we're supplying some form of protection within the box to prevent the contents from rattling around and getting damaged, and then we're providing strapping and protective polythene covering to attach the boxes to a pallet that allows it to move smoothly through the supply chain. So simple definition, the left-hand side of the slide, that sort of packaging, that's not us. The right on the slide, that's exactly where we are. And we have something around about 60,000 SKUs in that secondary, tertiary protective packaging arena. And again, I'll touch on those in a minute. Let me talk about each of the business units in detail. This is the main business. This is our packaging distribution business. 80% of our revenue. UK market leader. It's a very fragmented market. There's a lot of smaller, local, mama and papa type businesses who operate within this segment. And as I'll talk later on, part of our strategy has been to start sucking these people up and integrating, consolidating the industry. So we're currently at 25% market share. Our nearest competitors are around about a third of our size. And as I mentioned earlier on, we're the only national player. So there's no one can do what we do on a national basis. So that means if any organisation wants Land's End to John O'Groats supply and control and systematization, we are the only person they can come to. If they want to allow their own individual operations, individual plants to do their own thing, then they can choose lots of different suppliers. But we are prime in terms of ability to operate on a national basis for national account customers. The business is structured. We have 16 sites across the UK, serviced by 2 national distribution centres. So we buy a lot of our goods in bulk and then redistribute them around the business. And the order cycle is we take orders today and we deliver tomorrow. So 90% of what we do is taking an order today and delivering it tomorrow. The customers that we deal with don't want the hassle of storing this stuff. They don't want the hassle of really dealing with lots of suppliers. They want almost a just-in-time service. So a big component of what we do is providing them with a just-in-time supply. They don't need to think about it. If they run out, they can give us a call and we can be there. Most of our sites are within 1.5 hours drive time of around about 85% of the potential market in the UK. In terms of the markets we serve, mentioned internet retail, about 20% of our business now is directly or indirect linked with internet retail companies. Because, as I say, we as consumers buy more over the web. That requires more protective packaging to make sure it gets to us in the right manner. And that business is growing dramatically, and all the estimates show that internet retail is going to be growing at 10 to 15% per annum for the next 7 to 10 years. And our growth will back into that. Logistics companies, people like DHL, Stobarts, Norbert d'Entresong or Wincanton, they are big clients of ours as they increasingly support their customers, not just with trucks and warehouses, but with packing of their products. They require protective packaging to do that. And again, on a national basis, we're the only company who can support them on that basis. And then the other sectors that we're involved in, electronics, aerospace, automotive. So more industrial applications where people need very high-end components, very expensive components, and they need those components to be protected, both in terms of the journeys that they're going through, the storage conditions they're in, the temperatures they're going to be stored and or used. So what makes us different? One of the key things that makes us different is our approach to market, and a very simple diagram here. Our focus is not about the unit price, the price of your cardboard box. What we're trying to do is to get beneath the surface of a customer's operation and understand all the add-on costs that go alongside the way they pack, the way they process, the way they store, the way they distribute. So our sales team are all trained and experts in the business of understanding our customers' supply chains, and we work with them understanding the costs that they don't properly understand. And that's the bit at the bottom end of the iceberg. And in reality, for some customers, the key thing is not actually the unit price of the packaging, it's the risk if it goes wrong in terms of insurance claims and damage claims and extra logistics costs to return packs and so on and so forth. So getting it right first time in terms of packaging is absolutely critical to save a whole lot of other add-on costs beyond the price of the box. What differentiates us, as well as the approach we take, just sort of really reflected on this slide, and I won't go through all these points of difference. We have a multi-channel approach. So if a customer wants to buy packaging from us, then go on our website today and buy it. At the other end of the spectrum, we can put a very sophisticated supply chain expert in who will work with a customer to guide them through how we can actually improve their supply chain by making better use of packaging and better types of packaging and better packaging of products. We specialise around internet retail and 3PL, third-party logistics companies. That's our real area of specialism. And I'll talk some of the customers that we've got case studies on, but it's customers like Lakeland, it's customers like Selfridges, where they bring us in and they require our advice and guidance as to how they should pack their products, how they should process packaging, the types of packaging they should use, and that's where one of our key differentiators is from our competition. On the left-hand side of the chart there, strategic supplier relationships are really important for us because we don't make anything. We are depending on people who make stuff. And a number of key strategic suppliers like DS Smith, like Smurfit's, like Sealed Air, names you may or may not be familiar with in terms of global packaging companies, they use as a route to market. They can go direct to market to some of the very large customers, but to some of the medium-sized and smaller customers, they need someone like Macfarlane to actually provide them with a service because they can't access that market directly because they're just not responsive enough to do that. Let me move on. Talk briefly about the other businesses. we have a design and manufacture business, as we call it, which represents about 10% of our revenue, and that's a sister business to our packaging distribution operation. And this business basically produces totally bespoke packaging applications. So a customer comes to us with a very, very high value piece of kit and says, this is the journey it's going to take, this is where it's going to be stored, design me a pack. So every single thing we do is bespoke packaging. And to give you an idea what that means, we do packaging for ejector seats, for Martin Baker. We do packaging for explosives, armaments, military applications. Our design is all MOD approved. If you're dealing with a number of the customers that we deal with, you've got an MOD approved design, and we have the best MOD designers approved in the UK. And once you've won a customer in this business, the customers are very, very sticky because their components are so expensive and so critical. If those components are damaged because of poor packaging, there's big insurance claims on them. So, for example, Meggitt is one of our biggest customers. Rotork is one of our biggest customers. You know, the airline, the brake pads for airliners, that's what we're packaging for Meggitt, for example. So you can imagine what happens if that goes wrong. So some very, very fundamental applications in terms of the design and manufacture business. And then the labels business is a standalone business. It's focusing mainly on labels that you'll see on consumer packs on retail shelves, not associated with the packaging business at all, runs a totally separate business, totally independent, and I guess we would classify it within these four walls as a non-core activity. But it's there, it's part of the group at the moment, represents around about 10% of revenue. The famous slide where you flash out all your famous customer names just gives you an idea of the spread of customers. There's no one customer that represents more than around about 2% of revenue. So while we've got some very, very big customer names there, we're not beholden to any one single customer. And as you can see, we're spread right across there from people like Lakeland, you may be familiar with, which is an internet retail customer, QVC, Home Shopping, we supply all the packaging that they use to send their products out to their customers when they buy them. Dixons, the Hut, one of the fastest growing internet retailers in the UK currently. And then from an industrial point of view, we're dealing with Bosch in terms of some of their components. We're dealing with Arga in terms of the packaging for some of their cookery equipment. So you can see a very, very broad spread across a lot of different segments of the UK market. Some numbers for you. We've just announced our 2014 results where we've sort of presented 7% sales growth and 11% profit growth and a 3% dividend increase. So I don't dwell on that. This information is in the pack and out there in the public domain. I think probably the most important slide is this one. This business has an extremely good track record of demonstrating an ability to grow profits wherever you are in the economic cycle. So over the last, we've got there 6 years, our annualized earnings growth has been around about 15%. That's a mixture primarily of organic growth with some acquisition activity. I touched on acquisitions earlier on. We've started a new program of acquisition activity, and that's impacted marginally in 2014 and will start to impact more in 2015. We did 2 acquisitions at the end of 2015, consolidating these smaller regional players. We've got another acquisition which will come to probably completed within the next 4 to 6 weeks, and we've got a pipeline of probably 3 or 4 others. So we would be expecting to do 2 or 3 acquisitions a year to supplement the organic growth of the business. In terms of some of the basics of the business, in terms of the financials, our market cap is getting close to 60 million now. It's 50 million when this was drafted, but we're sort of 55 million at the moment. We've been consistent dividend payer since 2004. Average yield has been around about 5% over that period. We're currently around about 4%. Dividend is well covered by earnings, and we are well funded by the bank. Bank funding is around about 20 million. Typically, we use between 8 and 12 at the moment, so there's a lot of depth there in terms of the acquisition program that we're rolling out. And there are some just sort of reflections there on some recent comments reference our 2014 results. So, you know, history is not a good teller of the future. So while we've got a good history, what is it about the future that gives us confidence we can continue the growth in earnings momentum that we've seen over the last 5 years. Complicated chart, I recognise. This is in the pack, so you get a chance to see it. In terms of growth, we see organic growth in terms of internet, retail and 3PL. Those sectors, we're going to continue to buy over the web more and more and more. There's going to be greater need for protective packaging to do that, and we're ideally positioned to take advantage of that. So we're absolutely confident about our ability to grow in internet, retail and 3PL. More and more organisations are recognising the benefit of actually consolidating the way they buy these sorts of materials. A recent new business win for us was Schneider. Would you believe Schneider in the UK had 16 suppliers of this sort of kit? You know, boxes, tape, infill, protective strapping, 16 suppliers. And once we're able to sit down with them and demonstrate some of the benefits, we're able to rationalise 16 suppliers out and not only give unit cost savings benefits, but also all the hidden costs of having to deal with 16 suppliers and also the benefits of standardisation across 16 sites. So national accounts is a huge opportunity for growth. This is on the schedule. I wouldn't want to be so brave as we're going to start planting flags outside the UK, because what we've been doing as part of recovering this business in the early 2000s was to retract back to the UK. But we are now beginning to see people like Schneider asking us to say, can you do what you do in the UK outside the UK for us? So there is growth potential outside the UK, but particularly in Northern Europe, Scandinavia, Germany, Benelux, and there's some work we're doing at the moment to establish an ability to service those markets, but not yet brave enough to plant flags in those countries. But we'll be driven by customer requirements. And then the final component in terms of our growth plan is acquisitions. This business is ripe for consolidation. We've made, say, 2 acquisitions at the end of 2014. We expect probably to make 2 to 3 acquisitions every year. A lot of the smaller players, the private family-owned businesses, where you've got owners who are looking for a retirement, not going to be able to pass the business on to, and we've got conversations around with about 30 people at the moment who are at various stages of saying, well, my retirement plan is 2 years from now, so chalk me up to have this conversation in a year from now when we can start actually putting something together for my retirement. And we pay between 4 and 6 times earnings for our acquisitions, and that covers itself very quickly because we can create synergies quite quickly in terms of our purchasing power and our operational scale. So in terms of growth, strong organic growth opportunity, outstanding opportunity in terms of acquisition, and then we've still got things we can do to improve the operational performance of the business. As we grow in terms of scale, we can source more effectively, use our buying power with our suppliers, and operationally, with the sites we've got, we will probably look to rationalise the number of sites. We need to have a number of sites because we need to be close to our customers to give them this very quick turnaround of orders. But on the other hand, we can actually optimise the network. So over the next couple of years, we will probably see ourselves reducing our site portfolio down to around about 2 or 3. All our logistics is run in-house. We have our own trucks leased, and we manage that all. And we have our own computerized software programs that ensures the routes the drivers take are cost optimized for operational efficiency and customer service requirements. So it's not just done on the back of an envelope by a logistics guy. It's very sophisticated, just as the major retailers would have. So let me conclude. This is a very simple business. Okay, it's not complicated. We have created a strong franchise with the businesses we've got. We've got strong operating companies in all 3 of the business sectors. And the key thing is they're not just good at what they do, but they've actually got clear differentiated propositions. They offer something different from the other people in the marketplace. In all the businesses, we've got good market positions. We're the number 1 in packaging distribution in the UK. We're the number 2 in the UK in packaging design and manufacture. And labels, we're in the top 5 in the UK. So each of the businesses already got strong market positions. And we've got very, very clear plans of how we move this business forward, supported by a very strong track record of performance, both in terms of earnings growth and in terms of returning that money to shareholders through the dividend. So I think I'm slightly ahead of schedule. So very happy to answer any questions. If there's any difficult ones, I'll pass them over to my CFO. Any questions, anybody? Oh, you have.
I had a question just to kick things off. You mentioned the industry is very fragmented. I'm assuming that's historic. Why is that? Why hasn't there been anyone consolidate until now?
I think the reason the industry is fragmented is because these sorts of products aren't very high profile for organisations who buy them. So they're very, very low on their priority list. So they often delegate it to someone quite low down the food chain in terms of decision making. And their natural reaction is to use a local supplier. And because the sophistication of the way they plan and order these sorts of things, like bubble wrap and boxes, isn't very good, they want an insurance policy. And the best insurance policy is to have someone local. So hence you've got this, the industry has grown up as a series of local companies. In terms of the consolidation, Macfarlane started the consolidation back 2008. Well, before then, probably 2001, 2002. So we started very early. We then added a next consolidation stage on in 2008, and we're now at the third stage of consolidation. The other players who look to consolidate the industry came in around about 2010. And that was the two big international or pan-European paper companies, Antalis and Paperlinks. And they decided that they were into paper distribution. Why didn't they just simply add packaging onto their range of products and throw some packaging on the back of the truck? And anybody who follows those companies will see they have abysmally failed. So I think this is actually, despite the fact it's very humble, in terms of the product, it actually requires a degree of expertise in terms of product knowledge, in terms of customer knowledge, in terms of supply chain knowledge, that anybody who's tried to consolidate it so far hasn't been able to achieve.
And when you make an acquisition, obviously you have the national capacity already, so it's not going to add to your ability to deliver for your clients. Are you in a position to kind of pick up key clients as a result of those acquisitions? I mean, do you target specific firms because of who they have on their client list?
Yeah, I mean, basically, we target acquisitions firstly, we only buy good quality businesses. We don't buy things that are damaged. We don't see it as our job to fix things that are broken. We prefer to actually just beat them in the market. So we're looking for really high quality businesses who may have a very good geographic position. And we have a couple of gaps in our geographic network. So there's some geographic opportunities. And then some of the other operations that we've bought, we buy them because of their customer list or because of their geography, in that we can actually just back them into our operations and take out the property cost, take some of the logistics costs out, and in some cases take some back office people cost out as well.
Gentleman just down here. Whilst that, a question of you, please. The dividend policy, I think it was a 5% dividend you declared, a yield. It's obviously down to 4 because your share price has gone up. Have you got a policy of retaining sort of 5% dividend or no policy at all?
Yeah. Thanks very much. My name's John Love. I'm the Finance Director of Macfarlane. Macfarlane's got quite a block of institutional shareholders, as Peter had mentioned, who are primarily in Macfarlane because it's got a good dividend flow. In terms of our policy as such, throughout 2009 through to about 2012, we had always guided people that we would want to see our dividend covered between 2 and 2.5 times. We're now getting to that sort of level. We don't have a policy which effectively links it to our growth in income, but we do recognise that as we grow income within Macfarlane Group, people will expect us to nudge the dividend forward, certainly to give a reasonable amount of inflation cover, but if not, to improve it slightly beyond that. In terms of looking at that, no formal policy, but we do recognise it's something, as well as having the nice chart about profitability going forward, we also want to back that up with the dividend moving forward gradually. We're very conservative in terms of the way that we approach it, so we're looking at the dividend in terms of we will increase it with an eye on the increase that we're giving, but also future years, because we don't want to be in a position where we increase it one year and then have to keep it flat or reduce it. We want to see a steadily increasing dividend.
So sustainable is what you're after, really.
Absolutely.
Thank you very much. Thank you. Thanks, Tom.
You talked about your overseas expansion. You intimated it hadn't worked out before. It seems a natural thing for you to do, to expand into the other European markets with this business model. What's the hesitation? What went wrong before?
What went wrong before is we got too big too quickly and too geographically remote. We didn't get to Nicaragua, but we certainly got to some way big gone places down in Mexico, which were pretty scary. We were in Guadalajara and all sorts of places. So a classic case, unfortunately, of a company who gets a little bit too sort of confident about its ability and goes out and thinks they can rule the world and then very quickly finds that they can't. So having retracted back, our focus now is on where our customers are going to take us. So that's the most important thing, follow the customer from my point of view. And the customers at the moment are asking us to be in really Northern Europe. So Scandinavia, the Benelux countries, and Germany. We're being cautious. We're a cautious management team, as you've probably picked up. What we've done at the moment to actually be able to service customers within Northern Europe is we've created a strategic partnership with the number one player in our market within the Scandinavian countries and the number one player in the Benelux countries who also operates in Northern Germany. So we now have strategic partners so that as we win business and as customers ask us to go into Europe, we can actually use them. We control the commercial relationship, we can control the design and the operational relationship. But in terms of feet on the ground in those countries, it will be done with our partner who will be paid a management fee to do that on our behalf. That allows us, A, to learn the market quite quickly, and B, to be blunt, allows us to learn about potential other acquisition opportunities outside the UK. Now, we've been running that for around about 18 months. So we see that program probably running for another 12 to 18 months, and that will then determine for us whether the European market does give us the growth potential that we see. But even despite that, there's so much still to go out in the UK. I wouldn't want that to be a distraction from what we're doing already in the UK.
Gentleman here.
I have two questions. One, you showed a slide on which you had quite a few very impressive clients, but how many of those clients are you the exclusive distributor to of your packing material? And the second question I have is that I noticed that in your 2013 accounts you showed a pension deficit of just under £16 million. And how are you dealing with that? Because that is, well, it might be thought to be quite a large deficit for a company of your size.
Yep. Okay, I'll take the easy question, which is the customer piece. I won't go back to the slide for reasons of time. The majority of our customers, particularly in internet retail, we are either the sole or the number one supplier. Okay? There are a number of others where they spread their risks across a number of suppliers, but particularly in terms of national customers, we tend to be the sole supplier or the main supplier where they have a smaller alternative. So just thinking about ones that were on the list there, Lakeland, brand you'll be familiar with a sole supplier. Selfridges, we just won that at the end of last year with a sole supplier. Home Retail Group just won last year with a sole supplier. QVC with a sole supplier. So without sort of showing off, there's a high proportion of sole supply situations that we're in terms of our customer base. And the other point in terms of our major customers is they are extremely sticky. Most of those customers have been with us for a long period of time. When I mean a long period of time, in excess of 7 to 10 years. So once we get our arms around them and once they understand what we can do, the customers tend not to see a benefit of changing. And because if you're national, they haven't got many other choices, you have a degree of lock-in as well. So that was the difficult question. John, do you want to answer the easy one?
Yep, quite simple. Yes, you're right. We have a pension deficit. At its peak, that pension deficit peaked at about 25 million. It was 16 million at the end of 2013. It's moved down to just under 14 million at the end of 2014. It is something that, from a board perspective, we manage very carefully, and I'm responsible for managing that. In terms of the liability profile in the scheme, we've been doing quite a lot of exercises. We've done the plain vanilla things that people have done over a period of time, closing the scheme to new entrants, doing things like pension increase exchange, freezing pensionable salaries. These are things that keep a cap on the deficit. It is also a deficit where we pay in quite significant contributions each year. So we pay deficit reduction contributions out of our free cash flow of between 2.5 and 3 million each year to bring that deficit down. One of the things that we did in 2014 was actually to change the investment profile so that it linked to the assets an awful lot more closely and to the liabilities more closely. And part of that is to reduce the volatility in the scheme. You'll probably be aware that bond yields have come down quite significantly over the piece. That actually helped us mitigate a lot of that issue, and it's been an issue for other companies. It's not something that we're complacent about, and there are other things that we're looking to do in 2015, some of them on the back of recent changes, some of them announced in the budget today, but we are very mindful, and again back to the fact that we're very conservative, we are very careful about making sure that people have to sign off if they're going to take a transfer value and do something. We want to make sure that they have had the proper advice before they do that. We're not going to come back to investors in 2 to 3 years' time with some sort of mis-selling or anything like that. We will make sure they've had the proper advice. So it is there. It takes up an element of our free cash flow. So from that point of view, we'd prefer it didn't do that. Our aim is to get that deficit down as quickly as we can, because like it or not, when you come to presentations like this, or even to institutions, there are certain people that will look at it and simply say, if it's got a pension deficit, not interested in investing. We're managing it down, and we're doing that very carefully.
Thank you very much. Thank you, Peter and John. I think that's it. Thank you.